Good morning, traders. This is Blake Morrow. You were listening to the Morning Edge webinar. I want to welcome you all back. We have an exciting second half of the webinar today. We have Ed Matz and Chris Baer both joining us this morning. We're going to do a little bit of analysis on the CAD, crude oil, and I'm sure everything else. So let me go ahead and grab these two guys and let me find them really quick. First, let me see. Here is Chris Baer. Chris, are you there?
Hi, Blake. Good morning. Good morning, everybody.
Hey, good morning, Chris. How are you?
Very good. Very good.
How's Brazil treating you today?
Wonderful. We're getting ready for Carnival, and that's a big event next week.
Very nice. Hey, I'm looking for Ed, and I don't see him just yet, unless I missed him somewhere.
Maybe he's afraid of the bull.
He might be afraid of the bull. He could be afraid of the bull. He might be running just a minute late, but I haven't seen him logged in yet, so I'll wait for him here for a second. So how are you doing? I know I just asked you that, but how you been trading this Canadian?
Yeah, it's interesting. I think a lot of what happened was that everybody had this big expectation about Polo's raising the lowering the rate, right?
Right,
and he's going to cut, and that in conjunction with the oil move just exacerbated it. I had put out charts, the weekly charts that showed the still going, and I had like a 139 and 141 as the range where it would stop, and it just kept going. And I can honestly say I never expected it to be anywhere there. And I'm going to say that there's three drivers to these markets right now.
And by the way, wait, before you name off those three drivers, Ed should be mic'd up. Ed, are you there?
I'm there.
All right.
Blake, I want to know what these three drivers are.
Yeah, me too, man. Let's let him go. Okay, sorry, Chris. Go ahead. I just want to let you know that Ed's there too. Okay, go ahead, Chris.
Well, Ed, I mean in more in a macro sense. And I think if everybody gets their arms around this, or their mind around this, that it could really help their trading. All these moves, everything gets really pushed much further than actual value. So value is becoming distorted because the drivers are Federal Reserve and Bank of Japan and the ECB and all these central banks. So that's one of the drivers. The second driver is the amount of money that's sloshing around and the speed in which it sloshes around. And then there's the programs. So what ends up happening is these three drivers push a move much further than you think. Like, what the hell is this thing doing up here at 145? It just, time and price don't match. And what's ending up happening is that the time aspect has become distorted. The price moves are just so dramatic, and
you talk a lot about that, Chris, and you have over the years. I mean, when you spent that year with us and doing analysis every morning, before the morning edge, you used to talk about time and price doesn't match up, and I think the point you're trying to make, and correct me if I'm wrong, is price moves too quickly in too short of a period of time, and it therefore becomes very overbought or very oversold based on that.
Yeah, sure, and I'd be interested in Ed's thinking on that, and also you Blake, what you see regarding that, because that kind of explains what's happening with oil and with I mean, I'm hoping that's what explains the moves with these violent moves within oil and UsCad.
Go
It's
ahead,
really
Ed.
interesting. I think there's a simple. There's always a simple answer. It's not necessarily the right one. That's the problem about simplicity. The simple answer, Chris, is, and you mentioned the word driver, is the aggressive, violent move fundamentally driven, or is it flow? Is it spec driven? And if it's fundamentally driven, then there's a real reason for it happening, and there's a likelihood there's real funds that are going in or out of that market and likely to stay in or out of that market. So if you think oil is going down to 5, and the reason is fracking and the fundamental change in the oil market and the nature of demand, then this is a fundamental move. If, however, and I think 3 of us probably agreed on this, you're of the opinion this is now in the capitulation stage, the speculative stage, where funds are going in that will not stay out. They'll come in and out. They'll move. The market is trading. Then that is a weak move. And the violence is not justified. It's not sustainable. If you like, it's a question of finding the right equilibrium point. And if there are buyers coming in because they're saying, oh, it's gone too far, this is silly, yeah, and there are sellers saying, oh, I don't care, it's going down forever, then you have an equilibrium point that will actually find itself going back up as the shorts get squeezed. If, however, there aren't real buyers out there, then the market will continue to go down. And that essentially is the difference between, and we tend to see this a lot in January for some reason. I've got my own pet theory about why we see the violence more in January than any other market, is everyone comes in seeking trend. It's 2016, it's a new year, I'm square, I've got a new trading block, I'm going, what's the trend? Oh, that's moved, that must be a trend, let's go after it. And then, oh no, that's not the trend, oh gosh, it's reversed, and then it whacked back the other way. And partly as a consequence of that, the correlations go out the window as well, because let's take Canada and oil.
I remember you mentioned that in January correlations go awry. Yeah.
And yeah, I mean it's well, now in February. So the interesting thing is at what point they come back. I mean, and Canada, you've got correlations, obvious correlations like Canada and oil. But at the same time, Canada's come. You've seen a disconnect within the connection, if you like. Last few days, Blake's been going about this, about how Canada and oil are starting to do something slightly different.
They are, yeah.
And why is that? And that is a clue in itself. I mean, why do you think that is the case, Blake?
Well, I kind of I believe, okay, the Canadian economy is not 100% dependent on crude oil. But the correlation has nearly been 1-for-1 for such a long period of time.
Can I interrupt you there?
Go ahead.
You know the percentage crude oil production actually represents as part of Canadian GDP?
I think it's like, I thought, if I'm not mistaken, it's less than 20%.
It's 3%.
Yeah, okay. Well, then there you go. I thought it was less than. I thought it was 3. More than that, but,
yeah, I mean, it doesn't matter what market you trade. 3 is less than 20 always. I can assure you.
Exactly, of course.
Guys, listen,
but there are a lot of associated services with oil production, so it's going to be much higher. Oil represents a lot more than 3% of the economy.
Yeah, right. But listen, after the last webinar where we talked about this stuff, I sent you guys the Mark Chandler work. Where he clearly identified that there are times that it's more correlated to oil, but most times it's correlated to flows, and flows have to do with rates. So that's pretty interesting.
It is, and you guys, I don't think were around when I told this story, and this is I'll make it really quick. One of my closest friends, my best friends, he's the
We're not your best friend?
No, a guy I've known my whole life. He's the president of a publicly traded company, and he was there. They do like an energy drink type of company, and they're big, a relatively big, well, small company, but big small business. Anyway, they had a financing deal from a Canadian group that he signed like in October of last year. I remember going to his house. He was so happy. We're getting $5 million from this Canadian group. And then, I talked to him like about a month ago, and he's like, man, I'm still, I can't get these Canadian, company, this Canadian guy to go to get the money to us. They've sent out their team. They've done their due diligence. They've signed a letter of an intent and blah 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 blah. And I said to him, I'm like, have you seen their exchange rate? He's like, oh my God, I didn't even think about that. And I'm like, yeah, that their $5 million investment in Canadian dollars was probably about $7 million when you guys first talked. Now it's probably closer to 7.5, or it was maybe 6 million. Now it's more like 7 million Canadian dollars right now, just a few months later. So you can see how that and they ended up having a conference call. They're working through. They had to revisit the numbers because of the exchange rate, and that was the whole reason. But you can see how it affects. I mean, that's just one example of a small business. But
that goes back to the point about the violent moves, whether they're sustainable or not. You have if Canadian companies were of the opinion that dollar Canada was going to 2, and that's where fair value was, and therefore they needed to act, they wanted to invest in your friend's company, they would have to act now, and they would, because they still see it's relatively cheap. But they don't see that, and so they're not going to say this. All you will see then, in that respect, assuming that's correct, then you'll see it's spec, and it will eventually, the bubble will burst and it'll come back down. In the meantime, unfortunately, what tends to happen quite a lot of the time, the market goes sideways and they'll do the deal. But that's beside the point.
No, but you know what I'd like to say. I just want to touch on that. So Ed, if I was viewing the market as a big chunk, I'd say the top in the old days, the top 20% was spec, and then underneath that you had 80% fundamentals. Now I'm going to tell you that it feels to me that most of the market is spec, okay, and fundamental buyers, that doesn't come in till down 60-70%. So what I'm saying is I feel that from these three things, the speed of the computers, these robots, the amount of money sloshing around, and the absolute involvement of the central banks, that the fundamental is so way down there, you just don't know where it is. It's almost impossible.
I happen to believe that fundamentals were always out at some point, at somewhere, but the problem is fundamentals will change as well. In fact, obviously, it's not just cause and effect. It's not chicken, it's chicken and egg. Sometimes the fundamentals, oil, Canadian dollar weakness will actually prompt a recovery in the oil price in itself eventually, and the Canadian dollar will strengthen as a consequence eventually. And so it's not one way. It's not a one-way street. The problem, we're all bound to think that, Chris. It's the nature of the beast that life is always different and it's evolving, and there are new things, and therefore it will have an effect. And I'm convinced it has had an effect. But at the end of the day, when you strip everything out, it's still the fundamental drivers are right, and where it's still spec money, and it's still central banks. The central banks used to intervene in markets a lot more, certainly in the currency markets, and distort the currency market arguably a lot more than they do now. It's just, it's almost bells and whistles. What is interesting, and I think where your point's really valid, is the nature of short-term volatility.
Hey, Ed, I don't want to interrupt you, because I want you to keep that thought in your mind. We have ADP non-farm coming out like literally here within a few seconds, and I just needed to make sure it got covered, just because it's probably gonna be a market mover. It's the private sector jobs. Oh, here we go.
It's a real tip for Friday, isn't it? ADP.
Yeah, it is.
Yeah.
Yeah, and it looks like the data is coming in a little stronger than it had expected. 205,000 expected, 195,000. So the dollar yen spiking up a little bit. The euro dollar probably turned lower from, we were up near resistance. So the dollar is faring a little bit better. Not huge news, but it's improving risk appetite just a hair. Okay, now I'm done. All right, sorry about that, Ed. Go ahead.
That's all right. Do you want to tell Cable the dollar's a bit stronger?
Yeah, the cable's in squeeze mode, isn't it? Okay, anyway.
I've sold it. That's right.
Oh, okay. Okay, so we're going to talk about. I want to continue to hear
Yeah,
about your ideas here.
yeah, right. Let me tell you, this is a real
Okay.
bee in my bonnet, and it does relate partly to fractals. Well, it's more than just partly relates. It's HFTs, and the argument that they have no, you have on one extreme saying the HFTs are going to ruin the world, and they're going to cause crash after crash after crash, and but HFTs are there, in fact, to provide liquidity and therefore stop crashes. Well, evidence shows that they cause crashes, but what they do. And this is where I think they accentuate. Anyone who's a bit of a screen watch who trades really short term and short term, medium term, near term, every time perspective, then I see the difference. And the difference since the explosion of can't say it now, HFTs is really noticeable in those time periods. Short-term volatility has changed. I mean, real short-term volatility has changed quite significantly. Now, what that's done, in my opinion, is great because it increases the number of short-term fractals where the robots just take over. And particularly into something like Friday, when you have a big event, people tend to say, "Oh, I'm not going to do much before the big event." The robots don't know that; they just carry on. And so the robots, the nature of their short-term volatility, actually
Right.
increases, and it's really it's one thing for me. Again, on that point about fractals, short-term fractals, it's a blessing in disguise. The other thing, the real point, and this is where short-term violence comes into it, is people say that HFTs, they get in the way, they do whatever they're going to do, and then they present the price to the market. So there's no noticeable change. Wrong, because the number of orders that are not filled as a consequence of HFTs doing X, Y, and Z, and therefore the person doesn't get what they want, doesn't trade how they want, and therefore they're faced with a different position of saying rather than buying 10, looking for 15, they've missed 10. Now, do they pay 12 for 15? Well, no, the risk returns change, and next thing you know, it's 18. They pay 18 because they're panicking because they wanted to buy 10, and next thing you know, it's back 8 given and they're out. And then they freak out, and that is compound. And that's a knock-on effect. I'm talking about really, really short, because the market's increasing short-term trading. But the violence that creates, because the HFT is presenting the price to the market differently, is quite something. And at the end of the day, well, the euro is still 109.15, and it's not changed, and so says nothing's happened. But the HFTs have kind of drilled everyone left, right, and center, and as a consequence, you get this people chasing markets, and you get extreme, and I mean extreme, very short-term violence. And if you don't believe me, look at a tick chart of almost any market where HFTs are. You'll see it jump. You'll see it jump, it doesn't what's 5 pips in one market is different to another. But you'll see the market won't trade, won't flow like it used to. It will jump.
Right. Exactly. And
I
Mike,
love it.
could you put up that CAD chart you had?
Yeah.
Maybe
Yeah.
like a daily.
Oh, yeah, sure. Here,
And just show the uptrend. Ed, I'd like you to talk a little bit about this uptrend, if you don't mind. Look at that.
Yeah, I mean, okay, so let's stop and let's talk about this Canadian. And by the way, in about 4 minutes, Ed and Chris, we are going to take a break. I have two problems. First of all, I got to let Ziggy take a pause for recording. Second reason is I got to go get some coffee. So we're going to take a break in just a couple minutes. But you guys were here just a couple of weeks ago, and we were talking about the dollar Canadian and about what a great fade it was up here. I know you guys shorted. I shorted the hell out of the dollar Canadian. I know you guys did. Hopefully everybody did really well catching that reversal. By the way, I am short the dollar Canadian again, above 140.50 right now. And I'm still looking for a little bit lower prices. How are you guys trading the Canadian right now? Let's start with Chris. How are you trading it now that it's below 140 and we got the near-term reversal? How are you treating this, Chris? How are you going to treat this move that you currently see?
Okay, so for me, I've been out of the CAD because I'm a trader that likes to look for edges. Okay, and I don't mean like an edge, like an advantage. I mean like I like looking at. So right now it's in the middle of the range, and it's looking to bang out a bottom. So where that's going to be, I'm guessing is going to be somewhere around. pull up my. So Blake, I'm not looking at your
Yeah, no problem.
screen.
I'm thinking the 135 level, 135 to 137, but that's me.
Yeah,
Okay.
yeah. And look, if you have the real trend line on there, okay, you'll see that's that's right on, and the 5-0 of the last leg up is 137.57. So I'd look, and the 20 moving average is 135.76. So I'm looking for some sort of daily configuration that shows me a bullish pattern, and then I'd start to think, hey, listen, there's something here. But for me, there's nothing here more than oversold. It's just oversold on a daily, on the short time frames. But on the weekly and the monthly, forget it. It's not oversold. It's just starting to roll over. So what I'd need to see this trend to go back, start to get rock and rolling again, is a break of the daily trend line, and that's just not happening.
Okay, and which is much further down. I mean, we're talking about 135. So you're thinking it's kind of mid-range right now. You're going to start looking for a low sometime soon, probably in the 130s is what you're thinking. Ed, how are you approaching the dollar Canadian right now? Personally, how are you trading it? What are you thinking at this stage?
I'm a buyer right here and now.
You are? Okay. Well, we are on opposite sides of the market. Now, tell me the reasons why.
Oh, well, there's several. We're going to take a break because there's about 3 or 4 powerful reasons why I'm a buyer here.
Damn, I guess we're going to have to. So wait, before we do that, okay, so we're going to talk about the Canadian when we come back. That's great because, like I said, I'm short, but I also am short from the last, I don't know if you guys saw late last night. Both of you would have been asleep. I blogged about about crude oil coming out of a descending wedge. I blogged right here. Okay.
So, well, let me be naughty then.
Okay.
So, are you happy to buy oil right here?
No. It would have been last night, but we're getting towards the 38% retracement, which will come up around. It will come up right around the 31, $32 level. It's right here, 31 and a quarter. There's a 38% retracement. So I think once we get there, if we get there in crude oil, then I think the Canadian may turn. But I'm also in the camp that I think the dollar Canadian's got huge stops perched below 139. We're almost at new trend lows. So I think that these stops, I told people this morning, I think these stops are going to get triggered, which they look like they're going to right now. Here they go.
What time period?
An hourly. Here we go. We're going through 130, and we're going to see 138.55. This is very juicy. So see all the stops getting triggered right now? That as I said earlier this morning on the morning edge, I think we're going to trip all the stops below 139. See the 127% extension. But that's my near-term view, very near-term view in the dollar Canadian. So I'd like to hear why you think the dollar Canadian is going up, because I think it's going to go down then up, but you tend to be more of a swing. You can swing a little bit longer than the average person. So I'm really interested to hear your views here.
Well, there's several fold. One is, as you well know, anyone who's followed, it is difficult not to cover the same ground as covered before. 1998, the price action in dollar Canada is spitting image of now September 1998. Carbon copy, just remarkable. Basically, it called for a move from. It called for a 10 figure move to 144.80 in a period of 68 days. It then said the market should reverse 5.3% in 13 days. 5.3% was 139.10.
Wow! Wait, I'm sorry, Ed. And Chris, are you guys watching the euro right now? Are you watching the euro and the cable and the dollar is just getting absolutely hammered right now? Holy cow! I mean, across the board. Hold on, really fast. This is all, guys. Look at the euro breaking out of this consolidation. I didn't think it was going to happen ahead of NFP. This is the massive. I don't know if you guys have been following this. This is a massive daily downtrend line of the euro. we've been talking about the potential of the dollar really pulling back, and here this week, and the dollar is really coming under some assault here. Um, um, wow. I'm sorry, Ed. I didn't mean to cut you off. It's just things are happening, obviously, just developing right now. Can we do this? Let's take a couple-minute break so Ziggy can stop the recording and start recording again. But also, I want to hear the 1998 analogy and the other reasons with the dollar Canadian as well. So so we're going to take just a couple-minute break, guys. Ed, Chris, you good with that?
Yeah, I'm fine. I'll get myself a cup of coffee, so if I'm not around, shout, yeah?
Okay, yeah, I'll be shouting. All right, I'll be shouting, and I'll see you guys in just a few minutes. You guys are listening to the Morning Edge webinar. Back with Chris and Ed in just a few minutes. Chris, you good? Cool. We'll see you in just a couple minutes. All right, traders, this is Blake Morrow. You are listening to the Morning Edge webinar. Let me grab Chris Baer. And Chris, are you still there?
Yes, sir. I'm here.
Hey, sorry about that. We wanted to take a little bit of a break, just to get Ziggy a chance to re-record. And let me find
Absolutely.
Ed. There he is. Ed, are you there?
I'm there, sweetie.
Oh, hey. All right. Sorry about folks. Sorry about the break. Just had to break really quick, and we are good to go again. And now I got Ed whispering sweet nothings into my ear. This is nice.
Okay. Forget that.
So we've got obviously, as we're sitting here, what's really interesting, and speaking of high frequency trading, Ed, I mean, think about that. We had a decent ADP non-farm. The dollar gets demolished following the ADP number. Everybody's sitting here, like myself included, we're looking around going, what the hell did that just happen? Why'd the dollar just weaken? And, isn't that doesn't it seem like very predatory type of price action from a high frequency trading standpoint? Like, let's catch the whole market off guard and let's just press, dollar longs right now. Doesn't it feel like that?
Yeah, yes, except I'm less so, I would say, than historically. The HFTs that do that move the market and appear to screw people, have less of an agenda than many of the previous big players who used to do it. Is there a scene in Trading Places when they go after the stops? I think there is when Billy Ray takes over. Anyway, it doesn't matter. Time and time again, look, I started working in Citibank and investment banks at a time when there were some serious big players, and all they wanted to do was go after.
Hey, Ed, I lost Ed. Ed?
Hello?
Hey, yeah, your microphone just switched, like your microphone just unplugged or something. And I'm listening to your. Chris, are you there?
Yeah, I'm here.
Okay,
Can you hear me?
Yeah, I can hear you just fine.
Okay.
So it looks like, Ed, your plug just came out, or your plug just came out, your mic got unplugged or something.
Yeah. Can you hear me now?
It sounds like you're in the bathroom. Yeah. So it sounds like we're hearing you from your microphone on your computer, not from a microphone that you have plugged into your computer.
Oh, okay.
Okay, now you're good. You're good to go now. Okay.
You're
good. Okay.
Citrix threw up something, and I didn't notice it because I was looking at the market. I wasn't looking at your webinar page, and it was telling me I needed to do something. So apologies for that. I don't know what part my little rant you missed, but I was basically talking about the HFTs that seem to be predatory are no different. In fact, they're less predatory and less malignant.
Less predatory and more Momo, more trend. Just press the trend till it's dead.
Yeah, it depends what HFTs there are. You've got HFTs that are designed purely to trade things like ADP. So they're there looking, and if there's a reason for a move, and the HFTs, ADP HFTs are there, they're gonna go for it. So it's going to create volatility. The problem is, and you see this time and time again, particularly on US numbers, is that you'll see the market move for half an hour, And then the bubble, the air's gone. The HFTs have done what they want to do, and it goes back to very similar prices for the open. I'm talking more stocks here, but currencies move in line as well. But for the open of the New York Stock Exchange, so you'll see from this time now for the next half an hour, it'll do whatever it's doing, and then they'll drift back because the bubble's burst, if you like. But there are different HFTs for different type. They're algos. They trade for all whole same reason as humans trade. And so, whereas before, going back to the 1990s, 1980 style markets, there were big players and they want to know where the stops were, just not to stuff them in themselves, but they knew it would be a similar type of a little, if you like, hot air, a bubble. They'll take the stops, take the market out. They want, let's say it's cable. Let's say they saw the stops on 144.70, and so they start buying up through the stops. The next thing it goes 145.35. Everyone is stopped out. All the shorter-term retail market, they're all stopped out, and they'll say, "Thank you very much. 145.35 bid, yours." And the next thing there's no one to hold it anymore. And and so that's far more predatory, I think, than HFTs. So HFTs are just crunchy numbers going up, going up, going up, going up. Okay, that's the percentage move you tend to see at this point, and then they get out.
Could I say something just about that? I think we need to differentiate between trading robots and HFTs. HFTs are also a significant driver of creating distortion. Okay, because the bids aren't real, so they're just bidding right on top of each other, and they're driving that up till they just can feel. They're designed to feel that the bids stop, and then once that stops, that's why you get these violent moves. It's just you're telling me that the CAD changed this much from December to now. It's just nonsense. So HFTs are just a false bidding. They're high frequency trading. They're taking lots and lots and lots of trades quickly. Robots are a different thing, and robots are I think what people are talking about that are actually driving and taking cues from non-farm payrolls and news events.
Can you give me 2 minutes, guys? I'll be back.
Yeah, sure thing. And Chris, just on that same token, I agree with you as far as the high frequency trading versus robots, and the high frequency trading is basically just slicing up, providing a lot of liquidity, and trying to just get in orders a little bit quicker than yours. Hey, real quick, while Ed's just putting us on hold for a second. Yeah. Hey, you're talking about, like, let's say the euro dollar, and one of the things that I've been sitting here on the morning edge this week and actually talking with Paul Franco. Paul said, he's like, I think the dollar is going to get whacked this week, and I'm like, it looks like the dollar is going to get steamrolled right now. And if you look at this, I know you follow trend lines like I do. You look at the euro dollar daily trend line, this yellow one that we've been following for a while. We're approaching the 110 and what I think is major resistance here at 110.50. I saw Zero Hedge yesterday, and I just happened to be. I was driving. I just follow him on Twitter. I don't interact with him at all, nor do I really read a lot of that stuff. But he did say something interesting that the market has really priced in, or is pricing in, less than only one rate hike, I think, through 2016 now, versus before. Before the end of the year, we had 4 rate hikes priced in, a full basis point for 2016. And now I think there's less than a quarter basis point. Now that is a huge adjustment from the market standpoint. So I guess the question is the market right now, does the market need to readjust its dollar expectations? If that is the case, wouldn't the euro dollar be closer to, and I'm just using this as I'm throwing a number out there, wouldn't the euro dollar be closer to 114 to 116, maybe even close to 120, based on that, if that's truly the case, if that's truly the expectations of the market? What are your thoughts there?
I would say yes, without a doubt. If that the problem is the expectation of less of a rate hike or process of rate hikes is because the market is obviously global. Stock markets are weak, etc. And there are questions associated with that, and therefore the dollar rates won't go up so much, and so the dollar should come under pressure. The problem with I'm finding consistently we're translating that into a euro dollar rate is the level of volatility in the euro dollar. What is, if you're saying that the market's expectation of significantly different higher rates or not higher rates is so much different to, say, a month ago, and therefore, where does the euro dollar go? Well, euro dollar, it seems like the last year, but it's not quite the last year, it's been stuck at 104.65, 117.10. Now, the scale of the move then, so in respective volatility, it moved to 112.40, which is C, because that was what I'm looking for. Seems aggressive, but it's nothing. 117, 120 is much higher. So do you remember we actually did a webinar? We talked about dollar rates and what tends to happen after the first rate hike in the cycle, and you get initial dollar strength and then you get dollar weakness. This is what I believe is the dollar weakness. And I think dollar Canada is exempt. Is not exempt, but is doing its own thing, and has been doing its own thing because of oil. And there's a circularity because oil is obviously kicking the stock markets, which is why the interest rate perspective has changed. But so where do you put the dollar rally? Yes, the dollar will adjust accordingly, but where do you put it? Is cable therefore going back to 150, or is that a function of sterling itself doing something different? Is that because of sterling weakness? Because now sterling rates were going so high, and lower sterling rates means sterling currency weakness, and therefore cable won't rally so much. So euro sterling is going to go higher. The problem with all these things is the volatility. And our perspective of volatility has been distorted by January. It always does. And that's my point. And my difficulty is I'm bullish for 112.40, but you guys remember Pandora's box?
Yeah.
Do you remember 1990? Funnily enough, Pandora's box. I haven't got it to hand.
Do you have it in front of you?
Pandora's box. I can find it. Let me. Well,
because if you wanted to show it, I'd be more than happy to flip it over to you. That's why I'm saying that.
If you stay with me. I've got something.
By the way, equities are probably near closing in on their highs of the session right now. Gold gave a little false breakout, just for those of you that are following along the market at the moment. And if gold gave a little false breakout, the euro is probably going to turn from this resistance, I would think. Bonds are hitting new lows, so yields are going up. Probably stocks are probably heading higher too. We're 3 points from the highs on the S&P futures. Dow futures are about 25 points from the highs thus far. Well, Ed's looking. Chris, your thoughts on that euro? About the potential of an upside move in the euro.
Yeah, sure, Blake. I agree with your analysis, and I think it was just misplaced communication by the Fed and misplaced optimism in believing in the Fed that positioned everybody so short, so that and I don't think that the basic policy concepts that Mark Chandler laid out, that the Fed is in a tightening movement in that direction, and it may be 3 years, maybe 2 years, and that the euro is in a loosening movement, and that may be a 2-year process to get down to parity. So I think that is still in play, but I think the positioning is just completely wrong for this, like you said, 4 moves. That expectation was just completely erroneous, and yeah, beautiful stuff you're drawing right there, Blake.
Just something like this.
Yeah, really nice, and I think there's a lot of other aspects to the EU right now that are in trouble that are keeping it down, believe it or not. I believe there's other economic aspects and banking aspects that, people are saying like, yeah, the chart says get long here on rate expectations, but on the other end, it's like, what the hell is going on over there? It's falling apart.
Yeah, and I think if you we have a lot of Greek listeners, and I know I know some guys in Greece, and they all say the same thing. If you think Greece is gone, think again. Think Greece is going to come right back into the limelight probably soon, and the periphery is going to keep. One thing I've believed ever since Greece opted to stay in the Eurozone is that because of that, the ECB is going to have to stay looser for a lot longer than people believe. And so any type of recovery that we see here in the euro is going to be short-lived. So, whether it's, to 114, 115, 116, 112, as Ed thinks, I believe that whatever, significant rally you see out of the euro will be short-lived. Now, hey, Ed, I know you're trying to pull up Pandora's box. Also, don't forget, we want to talk about your views on the Canadian. I know you and I have differing views right now, but people can hear my views all day long. But they're interested more to hear your views because you're only here for a little bit longer. So did you have that, did you want to take over and show people anything? Is that what you're thinking?
Yeah, okay. What do I do to do that?
I'm going to make you presenter right now. It's coming on over. So you'll see the prompt here in just a second. So don't forget about the Canadian, and let's hear about Pandora's box. And Chris, thank you very much for your views. I really appreciate that, because I think you and I are actually very much in line with the same thinking.
Yeah.
Can you see my screen?
Yes, sir. Pandora's box.
Okay, this is ages old. This is 2012, this Pandora's box. I'm not showing it to say, hey, what a great call, but it was. It's basically projected euro back down to 100 from around the 140 area. Yeah, you can see the reason why. Basically, this is a synthetic rate, obviously because the euro didn't exist until the beginning of the blue box. It just repeated the same pattern. It's almost someone said, look, well, the euro's new. We better go back to 1985 and start it all over again when the dollar made its historic lows, because that's basically what it's done. And in that process, it's come down to 1, so therefore you think, hey, that's over. But actually, if you look at the scale of these moves, they are larger than this move here. And what I've come to the conclusion recently, rather than see, because I've been from a Pandora's box perspective only, of the view that, well, what does it do now? It could either do this. It could either say consolidate the base, which means it goes sideways for a long time. Well, we haven't seen the euro do that for a while. Oh yeah. Or it's actually more of this view. Yeah, this break here, this market here. So the move is much larger. It's actually in this gut here. Now, if you let me show you something that will freak everyone out. Going back to our conversation about the first rate hike leading to dollar, initially dollar strength and then dollar weakness. I need to find this. Okay, can you see that?
Yes.
Oh, that's way too big. Okay, this is Pandora's box. Pandora's box in the top left, basically you can see it's just repeating. This market is really weird, truly weird. It's just repeating itself over and over again. From 1985 to the time it started, 2000, it's just repeated it for the next 15 years. Wow, I mean, that's amazing in itself. Why it would do that, who knows? But it has. And essentially, basically what it's saying is broken, if you like, head and shoulders, call it what you like, and it needs to pull back, spikes back above it before it goes. Well, that's what this is. You see the implications. Can you see the implications from this chart? It actually says it takes out one, what goes, that's the equivalent of 117.10. So it says it goes more likely to 120 and then resumes the longer term downtrend. Now that's fine, that's heck of a call given that what the euro dollar's been of late, and it's still, nothing says that it's not still within this yellow circle. It still needs to break out up to the upside to produce that. And eventually, I mean, this is entirely consistent with the fundamentals. Going back to the point about, Mark Chandler's point about we're in a dollar up US rate hike scenario, there are always ebbs and flows. It's almost like Heisenberg's principle of uncertainty. They go to measure, the Fed raises rates. What does the market do? The market reacts as you would expect. Obviously, stock market off, interest rates up, dollar goes strong. So what does that do? That reduces the likelihood of them doing it again in the shorter term immediately because there's an overreaction. And so it needs to bring itself back. So it's ebbs and flows. So, yeah, I mean, it's kind of like, it's one of those things in retrospect that always seems so obvious at the time, never. And it's the same personally, I think, about dollar CAD and oil, that they seem to be disconnected. You can't believe that the market of the last 6 weeks has been oil and dollar Canada, and the stocks have been a spin-off of that. That relationship would break immediately in one. I mean, this is the relationship, oil and Canada going back the last 4 years, dollar Canada inverted, oil price going down.
How close is that relationship? I mean, that's so strong. Now, you know, going back to and thank you about your views on the euro, because, you know, that makes sense to me, and it probably does to Chris as well. But let's go back to your views on the Canadian.
Yeah, well, let me just say about the euro is, this is my problem and why you're seeing it everywhere. People are trading, euro traders are now trading the crosses, yeah? Because, you know, UsdCad, I mean, I think UsdCad is where it's at. Because if you've got the view like me, at some point, the euro is going to do something stupid to the upside just to freak people out. And I think dollar CAD is now spent on the downside. I've got my reversal 139.10, and for me, this is a real opportunity at these levels. Then it's, you know, I want to trade UsdCad. I don't want to trade euro-dollar because my reasoning, everything, I think I believe in what I'm saying on the euro, and yet, you know, 120 might be 112.40. And that's a massive difference, and I can't get my head around what is going on with the euro-dollar volatility, and it's almost a self-fulfilling implosion. You know, so that's why, likewise, the action is, you want to trade the euro-dollar, trade the crosses. Yeah, euro-sterling, euro-Canada, euro-Aussie, they're all much cleaner. And the problem also is once the market comes shorter term, short range like that, the algos dominate the volatility more and becomes even weirder. So, right, so CAD, what's the best thing? Dollar CAD and oil. Essentially, you can see where I was, or where we've been previously. Based on 1998, there's a reason that so many markets are 1998. Covered this last time without going into long history why you've basically seen the same type of scenario. You've seen a reversal in the oil market. You've seen an Asian crisis. The combination is not unique, but it's unusual, and it's 1998. Back in 1998, you saw oil dominate the markets, and also Asia dominate the markets. And oil ground out to bottom. What's really interesting about the current price action in the oil market, or not the price action, but the narrative, is that they're talking about emergency meetings. The reason why oil took so long to turn is because of the questions about meetings, the questions about quotas. Will they cut? Will they sustain the cut? The politics all behind OPEC was the reason why it took so long. And what are we seeing now? We're seeing the politics of OPEC. Are we going to have an emergency meeting or not? And so that, look, this is what happened in dollar Canada. It slowed it right up. Dollar Canada went sideways. And that, for me, you know, is I've been talking recently about trade what you see, not what you want to see. Is I think dollar Canada is going to go sideways for a significant period, which basically, you know, I'll give you 135. I don't think it's going anywhere near, but let's say it's 135, 147. You know, I don't really care in that sense. This is 135 down here. Later on, I'll show you how this translates. But basically, it's saying the trade is actually to sell Canada vol. Because it's spent, yeah. This is I think really interesting, and at the same time a little bit frightening. Can you see this? All right.
Yep.
This is a dollar Canada 1 month volatility chart. Now going back to full circle back to where I came in, where Chris was talking about volatility. You notice something about this chart. This is going back to the same thing about the euro dollar.
But
prior to 2000.
This is the VIX. Volatility, correct?
No, this is dollar CAD volatility.
Okay. Got it. Okay, sorry. Continue on.
They're not going to be that different, yeah? I mean, we know what VIX did in 2008, so they're not that different. Yeah,
Right.
and the correlation, people say, oh, Canada's oil, but hang on, you're saying it's S&P. Yeah, they're all part of that mix, and so is Timmy Hortons and Molson's and Nice, yeah.
Yeah.
All those they're part of the Canadian dollar mix, and whatever drives it will change. But what is really interesting, I think dollar Canada's here. Yeah, I actually think it's at low. Can you see that? All right, where I'm squiggling now.
Well, I mean,
Top left. Oh, let me just
yeah.
find.
I can see your cursor. There we go. I can see that square.
Right there. You see the arrow?
Ah, okay.
Nice. Got it.
Okay.
That works.
That's where I think we are. Precisely that point. That's 135. 134.60 is. I use Paint because it's so simple and easy and does everything I want, except I can't. I'm trembling. He's trembling. It's the DTs. Okay, that's 135. Yeah. Now that's what it's saying is basically this is my view here encapsulated. There. That is. Previously, I was looking for 144.85. Here, let me show you something. Remember that. I'll come back to that. Where's that previous chart? Just so people know where. Here we are. Right, can you see that?
Yes.
Okay. Right, this is where, from the break of 135, if you like, 134.60, projected for me 144.80 within 68 days. It got there sooner, actually got there quicker, but and then went to 146.90. We talked previously about doing the trade that puked. I puked twice on that. I sold it twice, and eventually I bought puts. Yeah, no, I mean a lot. I think the vast majority of people did not stay with that trade. That was one heck of a trade. And I've got to show you because I love. No, it doesn't matter. But anyway, so I bought puts because I knew this was coming. I thought I might be able to just stay with it and not get stopped out. But I got stopped twice before I was able to stay with it above 145, down to below 140 rather, and 139.10. This move back in 1998 was 5.3%. Previously, you can see where that line is. Previously, from where I thought it was going, 144.80, and this is my dilemma. Again, is about the volatility. Yeah, that is 137. That green line was 137. So anyone that's bearish now, and like you guys, you'd be saying, oh, well, based on that, I can see it go to 137. It's already gone 5.3%. It was supposed to do it on Friday. And I'm talking about pinpointing a level. I'm talking about pinpointing a day within a 150-day time frame, pinpointing a day and a precise level to a tick based on something that is 17 years ago. And the fact that it took, projected 10 big figures up and then 10 big figures down in the tool is pretty impressive. So I'm going to cut it a break. But in terms of volatility, it makes this move because it should have started, in my opinion, from 144.80. So 146.90. I'm now currently fudging. But there is something that helps me a lot within that, and it's this.
So Ed, you're long now?
Yeah. Yes.
And are you building the position, or how are you trading it? You're just building into it. You're building it. Okay, great.
Yeah. I tell you, Chris, I want to. Let me before I go into now. I tell you what I really want to do is I want to sell options. Hang on, I'm trying to think. I want to short volatility, but I'm scared to. The thing to do, like at the top, was to have sold calls, and the thing to do now is to sell puts, and I can't get myself to do it.
Blake,
yes.
Could I show a chart for the last minute?
Absolutely. We'll let Ed finish up here. Ed, let me know when I can switch it over to Chris.
Yeah. Okay. Let me. Will you let me have 30 seconds back towards the end?
Bet.
Okay. I don't need to show. There's something that is really quite dramatic. I wanted to show people that I only found out today.
Okay. So, Chris, I'm going to switch it over to you really quick.
Okay. Let me just show you one. Let me just say about the vol.
Go ahead.
This period here, up to 2008, volatility was pretty much 15% down to 2%. The whole vol in dollar Canada has shifted higher since then. Yeah, it's a higher range, And what worries me is we haven't. When dollar Canada did something very, very similar in 1998, September, we actually gone more violent, more quickly. Volatility is lower. And so what worries me now about vol is this spike. Is we haven't seen that spike. I don't, the nature of the volatility markets of options has changed. But look, we're not there. So that's what stops me on the
Right,
volatility side. What
which makes
does
me
that?
think that if we get that spike in volatility, that should result in a much stronger dollar Canadian exchange rate.
Yeah. So
Right,
this
right.
is why and I'll show you something about oil as well. This is why I'm definitely trading. I think I'm trading a range. I think this is a range. It'll prove to be a consolidation top for this move down. Yeah. But I am aware that vol has not done what it's done before. Look, this was right up. This should have been up. This is nowhere near where it should have been. It should have been up there.
You know what, and I'm with you on that, Ed. Now I'm short the dollar
Let Chris
Canadian
take over.
currently, but yeah, I'm gonna switch it over to Chris right now. Chris, it's coming over. But the thing is I think we might go a little lower before that happens. But I'm with you. Now I know exactly what you're thinking. You're thinking volatility is going to increase. I think stocks are probably setting up for. Chris, do you see it come over to you?
Yeah.
So I don't see your screen yet, and then I think that's going to set up for a move higher in the Canadian. Okay, so here's Chris. This is Brazil 61. Okay, go
Yeah.
ahead.
Do you see my chart?
Yep.
CAD chart? Okay.
Yep.
So that's a daily, and let me just pull up the weekly. So look, there's the weekly, and this is what I see as happening. And I see these spikes as normal commodity trading spikes that they just extend and then they can't continue, and then they reverse. And so if you look at this one reversed all the way to there and then continued its uptrend when some new information or new news or some kind of something reversed it. So I'm looking for that here. So that it comes down into this zone. That's about 135.67. And on the daily that I just had up, I'm looking for it to. What do the bears want? In my opinion, the bears want to take this zone out.
Exactly.
So if we're looking to get, we're expecting some sort of dollar retrace move based on a different idea about the euro and the GBP. I think the CAD will go along for that ride, and I believe that this will give you an opportunity, just like here, gave you an opportunity where it clearly said, look, I'm bearish, it broke, and then it gave you plenty of opportunity to get in here on shorter time frames. So you're going to know that there's a chance to get in here when this breaks. And as of right now, this did not break this downtrend line. When this price gets back on this side of this trend, I would tend to agree with that.
You know what, and I'm with you, Chris, and I'm going to have to take over from here because it's time for Kip to be here. It's Kip's coming on right now. Good morning, Kip.
Good morning.
Hey, and I just want to thank both of you guys, Chris and Ed, for your views. I'm really, interested to see how the euro plays out here over the course of the next week or two, especially over the next week or two, maybe over the next couple of days. Dollar Canadian, it should be. This is going to be a fight between bulls and bears. I do agree with that. Ed, your generosity is awesome, and same with you, Chris Baer. Thank you so much, you guys, for being here today. Really appreciate both of you. Are you there, Chris?
Yeah, it was my pleasure, and great listening to Ed and learning, two different perspectives, yours and his. And I really appreciate the invite. And hello, Kip. How you doing?
Hey, good. Good morning. Enjoyed listening as usual. Always great insight from you guys.
And Ed, thank you so much for all your views as well.
It's a pleasure, Blake, as ever. Kip, hi, and we'll let you get on, mate.
Yep.
And Chris, good on you, mate. Speak to you soon. All the best.
Yeah, great.
All right.
Thanks so much, guys. Bye-bye.
Thank you. And Kip, good morning to you. Really appreciate you. I know we ran over a few minutes. Sorry about that.